Hello, everyone, and welcome. This is Federico Invernizzi. I'm the Chief Operating Officer at MDOTM. And in this webinar, we'll be discussing the market turmoil we're living in and how to look at this through the lenses of artificial intelligence and our models. With me to discuss this, we have Tommaso Migliore, the CEO and founder of the company of MDOTM, Simone Facchinato, our Chief Investment Officer, and Axel Maier, our Head of Business Development. I'll leave them to speak in a moment. I'll just anticipate what we'll be talking about. We'll be talking about MDOTM briefly, our approach to research, so how we study the markets, how we operate, the current market situation, so a bit of context from Simone on what we are living, and then our positioning, what our models are seeing, and how we are behaving in this particular period. I'd ask you, everyone, to please go ahead and ask questions, write down questions. We'll be taking questions after the short presentation, and we'll make sure to answer all of your doubts. Axel, please go ahead.
Thank you, Federico. Good morning, everybody, and good afternoon to the participants from Asia. Investing has clearly become a tech challenge, and based on that understanding, 2015, Tommaso and a friend of him started MDOTM as a fintech company. So what do we do actually for our clients? For us, it was very important that we can deliver AI-driven investment strategies that are understandable and, more importantly, that our clients can control. And I think that was a very important feature of our early success, that at the end, the client has the control of the execution. So we could take away the fear and the concern about a reasonably new area of investing, which is artificial intelligence. And the way we combine the understandability, which you will see later on in the presentation as well, and the control element created a lot of trust for our clients. The other point was that the investment strategies we have is driven by a few things. One is very clearly that, most importantly, the input we get from our clients through various discussions with asset owners, but also the use of an advisory panel that we have that's comprised of a range of industry veterans from all fields of finance. And through that input, we can formulate what clients actually need. And this then is given to our very creative team of developers and innovators who build investment strategies around that it actually meet what our clients need and what our clients want, and it also reflects their constraints. And so we have been doing this for a range of asset owners, be it wealth management, insurance companies, pension funds, of course, family offices, and asset managers itself. And so far we developed 4 different strategies. One is a multi-asset strategy going across all asset classes, a single equity strategy, an alternative strategy, which is replicating hedge funds or a group of hedge funds in a very interesting way, again, depending on the client demands in a long-only way, and a proprietary trading strategy. So this is kind of, in a nutshell and very quickly, the way what MDOTM is and what MDOTM stands for.
Thank you, Axel. I'll leave Tommaso to dive into our approach to research. So how we look at markets, where we start from, and how we do it.
Hi to everyone, and good afternoon to our Asian friends. So basically, I'm going to dive briefly into how we approach research in general and how our investment philosophy actually works. So we start by one strong claim, which is AI is just a tool. Artificial intelligence is a major step forward, but it is actually a tool. So if we think at artificial intelligence as a crazy machine where you can just, funnel in as much information as possible and expect this machine to, by itself come up with, quality information, that's not really the case. But we will see that it is indeed a powerful tool. But everything starts with finance. Everything begins with finance means that when you apply advanced statistics or clever statistic, we could say, which is effectively artificial intelligence, you have to apply it on an environment that you understand as much as possible. So we start by understanding a market dynamic or a market anomaly, and then we apply artificial intelligence to catch it better and dynamically as time evolves. We say AI is a tool, but I'll show you this quick picture. I don't know if you can tell that, if something is strange, but actually the picture on the left-hand side, the eyes and mouth of Mr. Einstein are upside down. This is interesting because if I go back, it's really hard for us to see that little detail when the picture is upside down. We're really good at saying this is Einstein, but we struggle to see that details. This just shows you the difference between man and a machine. A man is really good at catching, human brain is really good at catching a generalistic, concept. So we're really good at identifying things, but sometimes we struggle into little details. That's where the machine can actually bring value. So as we've seen, artificial intelligence allows to do that, but more than that, allows to be adaptive. So we represent this problem by, presenting the financial market as a square. Imagine that we work where the information out there on the financial market is represented by a big square. Now, the problem compared to, for example, image recognition, chess, whatever, is that the financial market is an open environment. We always have outside information coming in, and we're always dealing with limited information, whether we're discretionary, traditional quant, AI, whatever. And our job is to catch within the big square just a little bit. And this picture, an animation, kind of shows you the benefit of an AI approach. The problem is that the market do move, they change in shape, they evolve, and you don't want to be stuck in one point represented by the red dot as this happen. You want to be adaptive as conditions move forward. So it is a tool, but it is an interesting tool that has some clear upside. Now, what is the main difference between traditional quant and artificial intelligence? So I'm going to make an analogy with the pharmaceutical industry. And basically, I'm going to show you on the left-hand side what a clinical trial looks like. Now, the clinical trial is the last step within a drug development. You divide your sample into 50-50. 50% gets a placebo, 50% gets the real drug. And then you see if the drug is actually effective. Now, this is actually the last step into a drug development. Okay, actually the drug development takes a different route. It first starts by understanding how the drug composition interacts with the cell, with the virus, with the bacteria, whatever. And if we're able to understand that interaction, then we're able to infer why the patient gets better and then move to the clinical trial. Now, for many, many years, quants relied too much on this bit, on the clinical trial, to develop the model, which is, classical backtesting. So it looks basically like this. You try a drug, a model 1, model 2, model 3. You reiterate the models until you're happy with the performance, and then you can do it in a scientific way. I'm not saying that everyone has done it badly, but often this has been the case. You change, and then you end up risking a big thing, which is basically overfit. So how do you check once you develop a model that your model is really relevant? If you're just changing the model, expecting different results. And this is where we think that artificial intelligence actually opens up a new chapter for model development, because those same spots that we've seen as model, they can be seen as a whole surface. Now, if we stop for a second, the axis of the surface represent the return. The higher the point is, the higher the return it is. Holding period, how much you keep that portfolio, that security, that stock in your portfolio, and then the look back period, how much you look back to formulate basically your model, to come up with your measure. Now, the same point that we've seen before, the dark one, those are the one that we've seen before. But actually, if we want to expand, and the machine allows us to do so, we can actually see the deepness on if we variate, if we change all the single parameters in every single granularity as possible, that actually draws a surface. And what we can clearly see from that surface is that it is an unstable surface because it has a lot of peaks and valleys, and therefore the portfolio on the surface tends to be an unstable portfolio. An unstable surface is not reliable because the peaks and valley moves a lot as finance change. And so the desired outcome or the expected outcome might change a lot. You would expect, to have your return up here, but as time passes by, you might be down here. So how do we do what we do? We do it like this, basically. So we start by basically changing within, the surface, all the different parameters. The different parameters, we look at, several hundreds of parameters, might be volatility, might be covariance, might be the known factor, momentum, value, size. Basically, we change them, and the goal is not to optimize for the parameter, but it's rather to stabilize the surface. If we have a stable surface, it means that no matter where we're positioning, as you can see now in the slide, you would expect a very similar return. And this, going back to the pharmaceutical example, this is not a clinical trial. This is not a backtesting. This is understanding how the model interacts with the market dynamic. If we're able to control that, meaning that we have a stable surface, then we can, project and have, the clinical trial. But that's just the last step. Now, we've seen an animation that shows one picture after the other. Actually, you have to imagine that, what artificial intelligence allows us to do is not really, reiterate as a human would do it, but it can do it more like so. So analyzing different surface with different axes, with different parameters, all at the same time in real time. And this is a great advantage because it allows us to basically monitor how the surface changes now, and so be much quicker into understanding if the model still is effective or not. Now, this concept that I tried to kind of give you a brief introduction is really key to understand the next section, which is actually what our model is seeing and how is it interpreting the current situation.
Thank you, Tommaso. So I would quickly sum it up before leaving Simone to explain a little bit of the context we're living in. As main advantages of AI and this new approach, first of all, adaptiveness. So you are not stuck with an old model as the market evolves. Second of all, the in-depth analysis you can make. So you can control many more parameters, much more in-depth, how they evolve over time, how they interact one with the other, and you can have a grasp on that dynamic. So these are the two key takeaways, I'd say. Simone, would you please go ahead and tell us about this crisis we're living through? How does it look like compared to the past, and what can we expect going forward?
Okay, thank you, Federico. Thank you, Tommaso and Axel. Let me say that we have to understand the context because if we understood the context, we can understand which parameters are relevant, and so we can better inform the machine in order to operate. So let me say that this context is a context of a crisis, of a recession. That's very clear. Even Mr. Draghi on the Financial Times said we are living in a recession. So we have to start from saying that we are in a crisis to navigate like all the previous ones. It's key to understand the root causes and what makes unique this crisis relative to the others. That's why we are looking back to the last 100 years. It's key having tools able to decipher market behaviors and to separate noise from signals. So now you can see how the different crises evolve, starting from 29 crash. And then, please, Tommaso, go on with all the other crises, the 30s, the crisis of 70s, the inflationary bear markets, and the crisis of this millennia. The first one, the dot-com burst, then the great financial crisis, 2008, with Lehman default, then the emerging market crisis with Chinese renminbi devaluation 2015, and finally, the last one, the COVID-19 crisis. So here you have how deep was this crisis in terms of negative performances. in the equity markets, and how long now was the period, and all the different crises were quite different. What makes different this crisis relative to the others is the fact that, as Fed Chairman Powell said, there is nothing wrong in the US economy today. It depends, this crisis depends on the forced activities lockdown. The reason why it was so fast and furious, similarly to 29 crash, is because it's the first time we experience a pandemic influenza. And the economic uncertainty has increased very quickly. We still do not know when and how the lockdown will be removed. We could ask why market volatility is decreasing in the last 2 weeks. Because, as in the last crisis, governments and central banks around the globe stepped in to save the world. So let me now, after this brief point on the last 100 years crisis, give me now 5 minutes in order to share with you how the relationship between asset classes are changing during this specific crisis. Let me use the Sharpe ratio as a measure of efficiency, the ratio between excess return relative to cash and volatility. So you have 3 axes here. The horizontal, the x-axis represent the different asset classes. So fixed income on the right, equity in the middle, and commodities in the left. Then we have on the z-axis the Sharpe ratio, and on the y-axis the period of analysis, the look-back period. So how long we are looking back in order to see how efficient was performing an asset class. This is the surface of representing how the different asset classes were efficient in the different look-back period. This is
Simone,
how,
and here we're looking at before the crash started at the end of February. Okay.
Thank you. The surface has different colors, as you can see, in order to help us interpret the levels. Red is very negative, and blue is very positive. In the bottom, thank you, Federico, there is a timeline indicating now, the second week before the crisis started. So you have a surface where all the different asset classes are well differentiated in terms of efficiency. So you have information, you can catch some information from this surface. Now, please, Tommaso, we start moving the dates, no, from the first from the week before to the next 2 weeks, where the surface stop please before the 6th of March, please, so people can see that the surface dropped down in the first 2 weeks after the crisis. The surface dropped down quite uniformly. The relationship between asset classes did not change dramatically. I would interpret it saying that the uncertainty increased along the curve of risk without a big differentiation. After these 2 weeks, the surface started to collapse, and chaos and illiquidity took the floor. In this specific, how should we positioning and how the MDOTM model position the portfolio? The model opted for diversification. This is very coherent with my experience during crisis. It's key not to get trapped in the noise. We must avoid bet driven by noise. Moreover, it's not a good idea to trade a lot when there is not liquidity in the market. If we look to 2008 crisis, we know that all the asset classes increased their embedded risk premium and the recovery at different timing, starting with investment grade bonds and only after a few months included commodities and equity too. Now we move to these really last 2 weeks after central banks intervention and government stimulus. These 2 weeks are showing a first sign of return to the new normal. The surface are starting to show a sort of differentiation.
If I may add an interesting point on what Simone just said, is really this, going back to what we've seen on this crisis, the surface, what clearly represents the surface is a level of information. Now it's key to see this information as a surface and not as a chart, because otherwise you have the risk of exposing yourself into having a measure at a certain period of time, let's say 6 months. Okay, whereas it's key that we analyze the same information from 6 months down to 24 months. What's really interesting, 24 months, it's 2 years. And what we've seen as the behavior and the change in Sharpe, it's the same one across 6 months and 24 months look back analysis. And you can clearly see that before the crisis, we have two, same week where the information was, structured basically in the same way. And then what we see is that, the first 2 weeks, as Simone said, the surface collapsed because the loss was basically, just driven by panic selling, we could say. And so there wasn't yet a structural change in portfolio positioning. The operators in the market were not yet saying, these will be the winner, these sectors will be the loser, these asset classes will be the winner and loser. So therefore, we just see a collapse in the shape. But it's really interesting as we go onwards, the next, this step. So you can see that the information really gets destroyed. And it gets destroyed once again from 6 months, if we measure on 6 months or 24 months. So it's very coherent to what we analyze. And the interesting bit is that our model change the behavior on how it allocates. So our model tends to prefer a sectorial, for example, in the equity, a sectorial allocation rather than a geographical one. Why? Because a market is a linear combination of the different sectors. So if we take the S&P 500, for example, it's actually a linear combination of the S&P technology, industrial, real estate. So it's a linear composition of that. So the model sees that as a better way to diversify the portfolio and to catch, some risk premia rather than use the geographical. But as information got destroyed, our model cannot change the approach. It does the allocation. So rather than, opting for that, it actually opted to a more spread out allocation, we could say. So opting towards a geographical allocation rather than a sectorial one. And that's actually, or more than that, even in the fixed income, to a more spread out approach, so opting for a max diversification rather than catching, the risk premium that it was seeing.
Tommaso, if I may add, this is a big plus. I mean, we've been happy to see that and to be able to interpret our model and understanding what it was doing as signal got destroyed and noise was flooding the market, and see the model spread out the bets basically. We were happy to see that because, I mean, what is key, as Axel said, introducing the company and what we do is understandable AI, and we all know that sometimes in these moments of extreme volatility, models cannot be relied on. And we were happy to see that even if in this case, which is a terrible market outlook, we could see the model behaving rationally and we could explain what was happening. So the signal was being destroyed and allocation then was spread out as not to invest or divest from sectors that were moving on volatility rather than fundamental or strategic movements on their prices, basically. So I mean,
absolutely. And I want to add and stress one thing. Of course, it would have been best to say, hey, we sold everything and we went into cash in January and February. I mean, but that wasn't really the case. And as Simone has shown you, the quickness of that drop just shows you that the market wasn't ready. But I'm not just talking about the financial market. I'm talking about, you know, the healthcare system. We were not ready we couldn't have predicted this. And we can clearly see that the information to kind of make this prediction was not there. So the interesting thing is, if the market goes down so fast, you have to take it. There's no way around that. But the interesting thing is, how do you react? And as Federico said, we haven't seen the model kind of not having clue what to do and panicking out. But actually what it did was very, very simple. A little bit of the risking in the first phase and keeping the same bets that we had before, because you will see just a spike in noise rather than a destroyed signal. As the information got destroyed furthermore, then it spread out the allocation and completely changed the tactic, I would say. And as you can see in the last two pictures, I don't know if you can tell, the surface here is very sharp, goes up and down, up and down. It's interesting to see, and Simone kind of pointed out, volatility is kind of decreasing because of governments and central bank whatsoever. But the interesting bit is that the market is starting to kind of come up with, a reorder, I would say, a new normal. And this, though, doesn't mean that the information is all destroyed or got destroyed and our opportunities are not there any longer. If we see another metrics, another surface, which is the information ratio. Now, the information ratio, to a certain extent, in this sense, could be seen as a diversification benefit. Because as volatility of the market increased, basically who has an asset class which has a high information ratio could be seen as having a positive benefit to the portfolio. Now, if we take a look at a slightly different surface, same thing. This is the information ratio. The asset classes are just equity in this case, sectorial and geographical, to give a different point of view. And this is still from 6 months down to 24 months. Now, the interesting bit about this is that if we see the other surface, information got destroyed. Let's see what happens over here. So we started from the 14th of February. Let's see what's going on. As market deteriorates, new information is produced. So compared to the other surface, I'm going to go back to show you that in a minute, that we clearly see just a collapse over here, a collapse of information. If we see, the general form of efficiency, if we compare that to the information ratio, on the contrary, there are opportunities. So still within the noisy market, there are opportunities to pick some elements and put them in a portfolio, not really to manage the signal, not really, the goal here is not really, when the market is so complex, is not really to catch the best signal, but it's really to interpret correctly the noise. Now, we all know that in finance, the biggest problem is that we have a little signal, whether that signal comes from fundamental analysis, discretionary, quant, AI, whatever. We have a little signal and we have a lot of noise. Okay, so the signal to noise ratio is very, very low. Now, today, that ratio, it's even lower. It's close to zero because the noise kind of spiked up. So it's key in this moment to really be good at interpreting the noise more than interpreting the signal. And this is key. Even if we take a look at some of the sectors that we might think are clear losers. Travel and leisure. I mean, airline companies. We all know it's going to be a tough time for them going forward. But even though that it's a sector that we could say that's a loser, at this price point, is it a loser? Will it be a loser? And is the price point representing the right signal, or is the price point representing the noise that we see in the market? So this is the kind of distinction that we have to be very good at. And
if I may add a practical example on that, Tommaso and Simone, of course, you explained that to me. If we look at certain fixed income segments over the last few weeks, it was impossible to trade on those. I mean, the signal to noise ratio was negative if possible. So we've seen something drop and rebound over a few days, and making it practically impossible to take a total position on that. So that's a very good example of what you're saying.
Absolutely.
The liquidity was so clear, for example, in the inflation link space. If you think that these bonds are issued by government as a treasury, the price and the impact of illiquidity was dramatic, I would say. Sorry, Tommaso, please go on.
No, Axel, you wanted to jump on.
I think in that discussion between, separating the signal from the noise and the examples used here, we also should make clear, we don't say that Sharpe ratio is a bad indicator and information ratio is a good indicator. It's about looking at several signals, and here are just two examples that we use to show that if you just look at one indicator, actually you might come to the wrong conclusion. So it's important to add this up, that you really have that ability to separate the signal from the noise.
Yeah, absolutely. The Sharpe ratio and information ratio are just two measures to give a sense of what we are catching and what the machine is catching, but are two good examples because you can clearly see that opportunities are out there, and the opportunity that you can clearly see represented by consumer and staples, the utilities, healthcare sectors, the Nikkei 225. Japanese market nowadays, it's very good in a portfolio construction because of its differentiation benefit. More than the expected return, what's really beneficial is the control on noise, and the Japanese market is having a very positive feedback to our overall portfolio construction, as well as industrial or technology sector. So the thing is clearly this, even though we have to be, even though the model opted to a more spread out allocation, as we said, it still, signal some interesting, bets with a very limited, very limited, positioning. So it wasn't really much on these bets. And I think that, by being in this very difficult crisis that nobody would ever experienced before, it's interesting to see how a machine is behaving and how it's looking at this problem in a kind of different way, but with some similarities to a more robust approach that we tend to have as human. We might, as human, have many faults, many good things and bad things, but for sure, as we've seen in the first picture of Einstein, we're really good at catching an overall view. Models sometimes they focus too much on little details, and when things go bad, they lose that ability to kind of model the world that they're trying to model. So the interesting thing is that our system, they were able to kind of to adapt and not ever focus on the little detail, but kind of have a generalistic view, but still by keeping that intense level and intense focus on little details, and that actually creates a great advantage, especially in a moment like this, where volatility is very high, where uncertainty is absolutely high. That drives actually the volatility. And more than ever, we have to be very careful into how to make little adjustment to kind of sail through this tough market turmoil.
I guess that's
Thank you, Tommaso.
Also from a client perspective, right? Not to overreact and be very unemotional about the advice we can give. And I think that's what has been key part of our work the last couple of weeks, is staying unemotional and giving that advice that's sensible.